Thank you for joining us today for our webinar on the One Big Beautiful Bill Act and what you need to know now. Before we begin, I have just a few housekeeping items to go over. Today's webinar is eligible for 2 tax CPE credits. In order to receive the credits, you must be active for the full duration of the webinar and answer at least 6 of the 8 polling questions, which will appear on your screen throughout the presentation. Each polling question will only be up on your screen for approximately 30 seconds. While the polling question is up, you will not be able to see the PowerPoint presentation, but the slides will come back on your screen as soon as the polling question is closed. If you have any issues submitting an answer to a polling question, please send us a chat using the chat box on your screen as soon as possible with your answer. Everyone is muted, so please use the chat box to submit questions as you have them. You can download the PowerPoint slides through the GoToWebinar panel on your screen under handouts. We will also be sending out the PowerPoint slides and a recording of this webinar on our website by early next week. Thank you again for joining us. I will now turn things over to Matt Fox to go over our presenters and agenda.
Good morning. So today's presenters are here on your screen with some pictures. Sherry, myself, Matt, Ryan, and Pat. So basically the agenda as we go through here are going to be 3 different sections. First up being individual tax updates with Sherry and I will be presenting on that. Secondly will be a business tax update with Ryan and myself. And then lastly, we are going to have a R&D tax credit updates in 174 with Pat. And in each of these sections, as you have questions, please submit them. We will have Q&A at end of each of the sections. So please submit them so that we can answer in each of the separate sections, or we can answer at the end as well. To start it off, and first off, we're going to refer to this as OBBBA throughout, so we don't have to say the name of the whole bill every single time. So OBBBA was signed into law on July 4th of this year. A lot of provisions to it. What we're going to focus on is the tax provisions related to OBBBA. And basically, it was extending, making permanent some of the 2017 Tax Cuts and Jobs Act provisions, and also introduce some new tax policies. From an economic impact, it's projected to increase the long-run GDP by 1.2%, but also reduce the federal tax revenue by about $5 trillion over the next 10 years. Also expected to increase federal deficits by 3.8 trillion over the next decade, and it's focused on pro-business policies, full expensing and permanent tax cuts to drive investment and growth. And again, what we're focusing on is the tax piece of it, and the provisions that they're favorable, that extending or making permanent from TCJA and the new incentives. So with that, I'm going to turn it over to Sherry, who is going to start off with the individual tax updates.
Thanks, Matt. Just wanted to, you already heard Matt refer a few times to several key provisions being made permanent in this tax act, the tax provisions in this act. Just wanted to point out that I always find it very odd when we use the term permanent for any tax law change, because there is nothing permanent except change in the tax law. So just to clarify, permanent tax law just means it's in the tax law until somebody decides to change it. So starting with permanent tax cuts, prior law, we had some lower rates come into play in 2018. And you would notice we had 7 brackets before, we still have 7 brackets. In that TCJA bill that took effect in 2018, just a little history, you know, we started with the 15% bracket and reduced that. We've continued the 10% bracket. We reduced the 15% bracket to 12, and then on up through where the highest bracket was once before 2018, 39.6%, and is now and has been since then 37%. Those rates that began in 2018 were set to expire at the end of this year. However, under OBBBA, they have lowered those rates and made them permanent. So all those rates there in the 7 brackets, all brackets continue to be indexed for inflation after 2025. And they're also expanding the 10 and 12% brackets, the 2 lowest brackets, with basically a double inflation adjustment. So while all of the brackets are increased, indexed for inflation and expanded, the 2 lowest brackets will get an additional inflation adjustment. Just one planning point there when we're talking about these lower tax brackets being made permanent, and that now should allow us to explore other opportunities such as managing your income in those widened and lowered brackets, considering strategies like Roth conversions, while we know that we have these lower tax brackets. Again, permanent unless somebody makes some other change in a future act. Moving on to additional permanent tax cuts. Additionally, the standard deduction. If you remember, in 2018, most of our standard deductions were doubled essentially, and those have been increased for inflation over these past 10 years. We also eliminated the personal exemptions at that time, so we would have had about a $4,050 exemption, personal exemption for all of our spouse, ourselves, and our children. And those were eliminated at the same time the standard deduction was doubled back in 2018. OBBBA permanently increases the standard deduction at those doubled and increased amounts for inflation, and then also permanently terminates the deduction for personal exemptions. So for 2025, that is single and married filing separate is at $15,750 standard deduction. Married filing joint, $23,625, and head of household is at $31,500. So again, those were going to go back to what they were in 2017 at the end of this year. This bill makes that permanent, as permanent as it can be. Somebody change it. Another permanent tax cut in OBBBA. Prior law, we have been having a $2,000 child tax credit. That was going to reduce to $1,000 after 2025. And there was a non-refundable portion of that, $500 for other dependents. So once your child reaches after 17 years of age, they're continuing on to college, or you have any other type of dependent other than a child that qualifies for the child tax credit, you could also get a $500 dependency credit, other dependent credit. Those two items were supposed to, well, the $500 was expiring after 2025, and the child tax credit was reducing to $1,000. However, OBBBA permanently increases the child tax credit to $2,200 beginning in 2025. So this actually is kind of one of those retroactive changes. So it impacts this current tax year, and it indexes the credit itself for inflation, which we did not have before, including the refundable portion of the credit. It also makes the $500 other dependent credit permanent. So it increases the income phase out threshold as well for the child tax credit and the other dependent credit. So prior to 2018, we did have a lot of people phased out pretty quickly on these, on this child tax credit, but many more people were able to take advantage of that. As you can see, the 2025 phase out thresholds begin for single and head of household at $200,000, and for married filing joint for those who have income over $400,000. And that's where the threshold begins to phase those credits out. One of the other items that you hear a lot, I'm going to kind of switch gears here and go into some things that are new to the tax law in this bill. A lot of this was talked about quite a bit in the news. So I have in quotes here, no tax on tips, because that was a big talking point during the conversations leading up to this bill being passed. This is actually a $25,000 deduction, or up to a $25,000 deduction for qualified tips in certain occupations. So in order for, you could hear a whole lot of people saying, well, I'll just change my wages to tips, and then I'll get a $25,000 deduction. I won't have to pay tax on that. However, they kind of anticipated this, and so we are expecting the IRS to provide us by October 2nd of this year a list of occupations that are generally expected to have tips. So you have to be in one of these occupations in order to receive qualified tips that would qualify for the specific deduction. Employers will be required to provide occupation on forms W-2 or 1099, and then the qualified tips. The other thing I want to say, there's another point on here that they must be reported on a form W-2, 1099, or other specified statement furnished to the individual, or reported on form 4137. So just to make everybody aware, just in the last few days, the IRS has issued guidance letting us know that they will not be changing the forms for the W-2 and the 1099 for this tax year for 2025. However, this specific provision does take effect in 2025. So it does count for this year. And now for tips is not as big of a deal in that case. They're not going to have a place for us to list the occupation on the forms like this is supposed to be required. But if you get tips now or have employees that receive tips, you do know that tips are already separately stated in most cases on form W-2. So, so some of those things will already be in place. They will need to make eventual changes on this for us, and there will be some reporting requirements. I suspect that we'll need to somehow provide an other specified statement to our employees for some of these items that require it. But the IRS will not be making any changes to the 2025 forms. Qualified tips are voluntary cash or charged tips from customers or through a tip sharing program for your employees. Again, these tips must be reported on a form W-2, 1099, or other specified statement and furnished to the individual employee or contractor. Those can also be reported on form 4137 by the individual tax payer. So self-employed individuals in a specified service, trade, or business do not qualify. So Matt, we don't qualify, I'm so sorry. And doctors, attorneys, that type of investment advisors, there are a list of 8 or so specified service, trade, or business occupations that will not be on the list when they provide them. You must file a joint return if you are married. So if you look at the married filing joint separate options, there's several tax and non-tax reasons. Somebody may file a separate tax return from their spouse if they are married at the end of the year. This provision is not, deduction is not allowed if you do choose to file a separate tax return. So that is going to be another consideration to take into if you have this particular situation. Deductions do phase out for taxpayers with modified adjusted gross income of $150,000 or more for single, or married filing joint of $300,000. This is a temporary provision, meaning that it does expire. It's only available for 2025 through 2028. Another new provision is the no tax on overtime. So we heard a lot about that as well. And again, this is not really necessarily no tax on overtime. However, it does allow up to $12,500 for a single individual or $25,000 for a joint deduction for qualified overtime compensation. Qualified overtime compensation is any amount that exceeds regular pay rate of pay, so half portion or time and a half portion that is required by FLSA. So basically, for employers out there, that's going to mean, so we do track typically overtime on in our payroll systems, but the portion that is qualified overtime compensation, if you're giving somebody time and a half, is just the half portion. So it's not their full hourly rate. It would be whatever portion is above or exceeds their regular rate of pay. So that is currently not something that you would report to an employee on their year-end forms on the Form W-2 or 1099. They are not going to change the forms for 2025, so we will need to come up with some specified statement and ability to provide that to our employees. And we will need to know how to calculate that amount, and hopefully it's readily available in our payroll systems that we currently have. But I think that will be, I think some people might potentially report overtime compensation as like a full overtime amount, but we'll need to make sure that we're only including the portion that exceeds the regular rate of pay. Employers will be required to file information returns with the IRS and provide statements to the employees showing the amount of qualified overtime compensation paid during the year. So it'll be interesting to see how we implement this, given that it is taking effect already for the 2025 tax year. So, there may be some question here, and hopefully we know more information. We do our year-end tax seminar where we give additional information in November about the year-end information reporting returns, and hopefully we have a little bit more information to provide to you then on how we will need to handle that, because I do think that's still an open question. Again, you must file a joint return if you're married in order to take advantage of this deduction, and the deduction phases out for taxpayers with modified adjusted gross income over 150,000 for single and 300,000 for joint. So very similar to the no tax on tips provision there as well. And again, temporary tax years 2025 through 2028.
And Sherry, I would just add, like you had mentioned, a lot of times when we have a new act like this, there's new provisions, there's changes that, it takes some time to understand logistically, how do you get the information? How do you do what the new act is saying? And also, needing more guidance from the IRS, from Treasury. So a lot of the things that we're talking about today, there is some of that. There is some things made permanent that we have already been in place, so it's not a big deal. But there are other things that, as we go out throughout the year, there will be more information. We will be sharing, what we learn as we go through.
Yep, and we will keep an eye on this very closely, because this is one area that I know that we're going to need to help our clients with reporting on these topics. No tax on Social Security, another big one that we've been hearing a lot about. Again, not necessarily. However, it provides an additional senior deduction of $6,000 per eligible individual age 65 or older by the end of the year. So if you are 65 or older before the end of 2025, you will get an additional $6,000 deduction. If you're aware, if you are already over 65, you probably already know that you do already get an additional amount in your standard deduction. This is an additional amount in addition to that seems like it'll be an additional line item for $6,000. And hey, you can be over 65 and not be collecting Social Security. Social Security rules on taxability are still going to be the same as they are, where we could bring taxable Social Security into up to 85% of your Social Security can be taxable based on certain phase in, phase out. They didn't really change that piece of the tax law. However, they did add this additional deduction, which should be if both spouses are eligible. For example, you get an additional deduction of $12,000. So it does help, it adds an additional deduction there for those that are, again, age 65 or older by the end of 2025. Again, you must file a joint return if you're married. And this phases out. So if you're someone who is over 65, is still making a decent amount of money from other things, phases out when modified adjusted gross income is over $75,000 for a single individual, or $150,000 if you're filing a joint return which you must do if you're married. Again, this is temporary tax provision and is effective 2025 through 2028. State and local tax deduction. This was in the news quite a bit and was something that was going back and forth, and there were both the House and the Senate had different versions of this. And so they've, if you remember, in 2018, we started to have a $10,000 cap for taking state and local tax deductions and our itemized deductions, which was then set to expire at the end of 2025. Prior to the 2018 tax law change, there was no cap on our state and local tax deductions, meaning any income taxes that you paid to your state and local government, any real estate taxes that you paid, that type of tax typically. OBBBA increases the cap to $40,000 starting in 2025. So that means that this year was supposed to be a $10,000 cap. It's now $40,000 cap. That cap then increases 1% annually through 2029, and then it reverts back to a $10,000 cap beginning in 2030. So that's a lot of changes going on these next several years, and ultimately, after 2030, we can say that we have a $10,000 cap, permanent cap, unless they change something till then. The phase out for the cap, there's also, this is actually coming a whole new thing, begins when modified adjusted gross income exceeds $500,000 in 2025. So the cap can get reduced to $10,000 again if you have larger amounts of income exceeding $500,000. That also increases 1% annually through 2029. So all of this is a bit of a moving target. The deduction is reduced by 30% of the amount that the taxpayer's modified adjusted gross income exceeds those thresholds, but it can never be reduced below $10,000. So ultimately, if you have adjusted gross income more than $500,000, then you're probably looking at something between a cap of $10,000 and $40,000, right? So it gets reduced systematically based on how far you get above that threshold. So a little bit complicated, but anyway, but there is an additional $30,000 you could be able to deduct. One thing we want to point out with this, and pass-through business owners. You guys know that we've been making a lot of pass-through entity tax elections. Pennsylvania is not one of the states that currently has this option for our pass-through business owners. Maryland does, and about 30 some states do throughout the US. So this is something to keep a close eye on for our pass-through business owners. While this is a deduction limitation on the individual tax return, pass-through entities have to make this election at the entity level that can benefit their owners due to this specific tax deduction, so on their personal tax returns. So it's a very tricky area that I will say that you will need to pay close attention to. Every state's pass-through entity tax election is very different. Some of them are connected to the federal thresholds. Some of them were set to expire at the same time after 2025 when the $10,000 cap was set to expire federally. So this is something that we really need to pay close attention to if you are a pass-through business owner and how that impacts you in the various states you do business in. If they have a pass-through entity election, what your personal situation is of all the owners. So it's something that we're really going to have to pay a lot of attention to, especially starting in 2025. And you may have already been in states where you've had to make the election proactively already. There are some states like New York that require that ahead of time. So just an important planning point. There's a lot that we probably need to think through on this particular deduction, especially if you are a pass-through business owner and have PTE taxes. That we have our first polling question.
Guess we'll see if people were listening to you. If people got it right.
Do I just hit next to do that?
Yep.
So $40,000. Most of you were right. So 76% got it right at $40,000. Car loan interest. So this is something that prior to 2025, we've never really had a deduction, well, at least for a very long time, I'm going to say. Prior to my CPA license, when I used to be able to deduct interest, some of you may remember that for personal loans, but prior to 2025, no deduction for car loan interest for personal use car loans. OBBBA creates a new above the line deduction, so that kind of tells us that it's not necessarily an itemized deduction. It should be a separate line item on our tax return, and it's temporary again from 2025 to 2028. The maximum deduction allowed is $10,000, and that will have a phase out when modified adjusted gross income is over $100,000 for single and $200,000 for joint. The vehicle must be for personal use. You already get loan interest for a business vehicle, so it's kind of separate. Must be new, and final assembly must be in the United States. And we must have something presented that we will be reporting the VIN number actually on the return. The loan must be secured by the vehicle, and the lenders must file information returns and furnish statements to the taxpayers. So again, brand new item, so there's sure to be additional guidance coming out on this. Currently, the IRS does have this additional guidance on their website for the specific deduction. But again, not an itemized deduction, going to be above the line, so we should see something new for that this year. And that starts now. So I think that I'm trying to remember, I think you had to purchase the vehicle after July 4th. But,
yeah.
And Matt.
So there's also a new deduction limit on all these itemized deductions that we've been talking about. Previously, before TCJA, there was this PEAS limitation, which had put a limitation on itemized deductions. During TCJA Act, there was no, other than the SALT cap that we've been talking about, there was not a separate limitation on your total itemized deductions. But with OBBBA starting in 2026, there will be. Basically, it's going to affect just the taxpayers that itemize and are in the highest tax bracket of 37%. And it's just on those itemized once you start exceeding the start of the 37% tax bracket, which we have listed here for single, married filing joint, and married filing separate, where that 37% bracket starts. It reduces your itemized deduction by 2/37 of the amount exceeding this threshold. In simple terms, effectively what they're trying to do is anybody in a 37% bracket that's itemizing, instead of getting a maximum 37% benefit on those itemized deductions, that it's reduced 2% down to 35% is essentially what they're trying to do with this. So something that needs to be considered. Charitable contributions. So again, sticking on the itemized deductions topic, and also now non-itemizers, they're bringing in this is effective for 2026. If you're not itemizing, you still could get a separate line item deduction for cash contributions only, up to $1,000 single, $2,000 for married filing joint. So they're kind of bringing back a provision that was, I think, in 2020.
Yeah, they've done this like once or twice in the past, I remember.
So they kind of throw back to that of it was a lot lower number. I think it was $300 and $600 back when they originally did this. So they've bumped up the amounts, which is a nice provision if for people that aren't itemizing their deductions. What they also, part of the charitable contributions, is they're making the 60% of AGI limit for cash contributions permanent. that was set to revert back to the 50% after 2025. So that's made permanent now. New provision for itemizers when it comes to charitable deductions is this 0.5% of AGI reduction to otherwise deductible amounts of charitable contributions. So essentially what this is a 0.5% floor of that you're not getting those deductions until you're getting the deductions over that floor. So think of it as the medical expenses. This is very similar, except it's a much lower floor than the medical expenses are. So something that when you're itemizing in 2026 could have an impact on what that total itemized deduction looks like. And for a planning point, looking at these last two slides when it comes to charitable contributions and the overall limitation in what taxpayers that are going to be in the 37% bracket for, let's say, 25 and 26 might want to look at and consider is it make more sense to maximize those charitable contributions in 2025, whether that's through bunching or donor advised funds or some other way, in order to get that maximum deduction now in 25 instead of it being limited with this 0.5% AGI floor and the itemized deduction limitation that we had just talked about. So it is a planning thing that you have here in 25 that it might be something that needs to be considered, might make sense in certain situations.
And that is beneficial this year, but could also be beneficial in the future if you're looking at multiple years of donations.
Yeah.
Right.
Yeah. As far as loss deduction, so basically most of the things listed here were items that were part of the TCJA. They were set to sunset in 2025, and they're going to. So where for the first three here. So permanently terminates the casualty losses unless it's a federally declared disaster. So that's been ever since TCJA has been the rule that only federally declared disasters are allowable as casualty losses for itemized deductions. So basically what we see the most, especially the last couple of years, are hurricane losses in those federally declared disaster areas is probably the big one that we see. So that's an item that is set to terminate. Miscellaneous itemized deduction, same thing, was the fees for advisory fees for financial advisors, our tax preparation fees. Any of those 2% miscellaneous itemized deductions have been gone for during TCJA. OBBBA makes it permanent so that they are permanently terminated. And the same thing with moving expense deductions as well, that OBBBA makes that permanent to terminate it. The next three items are permanently limited. So again, under Tax Cuts and Jobs Act, have put in that mortgage acquisition indebtedness. You have a $750,000 mortgage limit on the outstanding debt, that if you're over that and it was acquired during the time frame the mortgage was acquired or refinanced during the time frame of I guess that was 2018 through now, you could be limited on how much interest expense that you can deduct. If it was before that, you were grandfathered in and you're at the $1 million cap for that instead. So OBBBA permanently limits that to the $750,000 acquisition indebtedness. Same thing with the home equity interest deduction. So Tax Cuts and Jobs Act had changed that. So before any kind of home equity interest was deductible, now under TCJA and OBBBA making it permanent is only subject to home equity interest that is related to buy, build, or improve a home. Again, so that's made permanent from now. Gambling losses. This is an interesting one. So basically, yeah, OBBBA made permanent the treatment of gambling losses, but starting in 2026, there is a slight change to it. So for anybody that is gamblers out there, could be a pretty big impact for some people. Previously, essentially, if you had $100,000 of gambling wins and $100,000 of gambling losses, you could offset the two and you didn't have any kind of taxable income. Now under OBBBA, starting in 26, you're limited to 90% of your losses to be itemized and deducted against the winnings. So in that same example, you would end up with $10,000 of taxable income, even though you had losses up to your winnings. And so
plus you have to itemize.
Yes. So you have to itemize. So there are other limitations that can kick in as well in certain situations. So I know that there is I think a lot of pushback by professional gamblers. So there could be more coming in that regard as well. One of the items that was added that's not necessarily a tax piece, but it is somewhat related, are these what they're calling Trump accounts. They are essentially they're new accounts that are tax deferred savings accounts for minors. They are structured essentially as an IRA account, and contributions can be made up to turning 18 years old for children up to when they're turning 18. And those contributions are capped at $5,000 per year, and they're not deductible contributions. The one caveat is we have a line here: employers can make contributions to the parent's children's Trump account. Basically up to $2,500 per year is the cap on those, and those contributions are not included in the taxable compensation of the parent. So that's kind of a little caveat to not being deductible. And the contributions aren't allowed until 12 months after the enactment of OBBBA, so essentially July 4th, 2026 is when this really starts. There's a lot more that still needs to kind of come out in regards to, since these are brand new, there's a lot of talk about them, but just how exactly they're administered, how some of these things work in reality, I think have to come into play yet. But so that's why there's still a time period for this to happen. There's a lot of talk of the parents can open the account, other people like grandparents can open the account, the government could open the account if it's not already been opened in order to fund the $1,000 for any children born between 2025 and 2028. So there's a lot of confusion, I think, of how that would all work. And so again, there's a lot more, I think, to come on exactly how these will work. As far as how the investment within the account, it would be restricted to mutual funds and ETFs. And then distributions aren't allowed until the age of 18. Once age of 18, they kind of turn into an IRA account from a standpoint of how they would be, any distributions would be taxed. There are, as of right now, they're kind of saying that there's some qualified distributions that you can make out for first-time home buying, education expenses, that wouldn't be subject to the 10% penalty. So like with IRA accounts, if you're taking a distribution before age of 59 and a half, you'd be subject to taxes plus a 10% penalty. So there's a lot of different things that need to be considered for these accounts, and what makes sense, what doesn't make sense. So again, more guidance to come, and definitely some planning of whether it makes sense or not. And the next poll question: what individual tax provision is most relevant to you? And it looks like lower tax rates made permanent is the top one, with state and local tax deduction increase being the next. I think
Makes sense.
that makes sense from what we would be expecting. A couple other provisions that we just wanted to point out, probably top one being the estate and gift tax exemption being increased to $15 million per person. So without OBBBA, this would have reverted to $5 million after 2025. So there has been a lot of planning over the last couple of years of, if this happens, that the exemption goes, down to 5 million from where it's been around 14 million. That's a big drop. And so, what needs to be done to, make sure to lock in the higher exemption and protect those assets from the estate tax. So, yeah, basically, when 5 million, roughly 7 million with inflation. So you're talking over double in 2026 what the estate tax exemption is going to be compared to where it would have been.
Just a little interjection here for our Maryland clients, resident clients. Maryland still has a $5 million. They have decoupled when the IRS or when the federal government went to the higher exemption before, they decoupled then and are still at $5 million without inflation adjustments. So you keep that in mind if you are a Maryland resident or own Maryland real estate.
Alternative minimum tax exemption has been made permanent at higher levels, which are also indexed for inflation. But OBBBA has also steepened the phase out for those with income exceeding $626,350 for single and $1,252,700 for joint. The adoption credit as part of OBBBA made a portion of that refundable up to $5,000, and also that's adjusted for inflation. And then lastly, there was an expansion of the 529 plan kind of rules from what's eligible expenses. One of it being including professional credentials. There's just a lot of different, I think, pieces that they've added. So, want to definitely look at that of, if you have making payments out of 529 plans, that is changing of whether it's now going to be includable in there in that definition. So instead of just tuition, there's a lot of other various miscellaneous expenses that might fit in there. I know, I think it was like tutoring type items is included in there. And the other piece that just wanted to point out with that is for K through 12 expenses, they have increased the annual limit on that from 10,000 to 20,000, and that starts in 2026. So I know there's a lot of people that might use that for private education for K through 12 and had previously been limited, but that will double in 2026.
And just a planning point on those 529 plans, those are your education plans, and a lot of times our states, Pennsylvania and Maryland, both have credits or deductions that are allowed for those, even though you do not get a federal deduction. So just a planning point for those that we already try to encourage, but this is just additional funds for things like that.
So we will do Q&A for individual updates.
So we do have currently 2 questions. Do military personnel still get a moving deduction?
Yes, they did not change that provision. They just made permanent those moving expenses that were already not deductible, that were going to be deductible again, but now are not. But yes, military still qualifies.
Do you need to purchase the new vehicle in 2025?
There's a time frame that you have to purchase it in, starting in 2025.
I think it might have also been the July.
I think it was the 4th of July.
Yeah.
I didn't have it on there, but I think it's the date of the bill.
Yeah, and I think, so at the very end of our slides, we have a link to, one of the hardest things in these updates is the effective dates of this. So there is a timeline document. It's a very nice one-page document that has when the effective dates of a lot of these different provisions are. And I think it's in that document, but we can always get back if it is not.
Can the senior deduction be taken for age 65 but no Social Security income?
It's my understanding, unless we get further guidance that says not, that you would qualify for that even if you are not taking Social Security at this time. Yes.
Yeah, I believe it was kind of always linked to Social Security, but it really is not anything to do with Social Security. It really is just a new
An
deduction
additional
for
senior deduction is what they're calling it, even though they always saying it had to do with Social Security. It does not technically hinge on that.
Have you had any discussions with the payroll service companies about the overtime provision?
Not as of yet, because we literally, it's been like 2 days since we heard from the IRS that they are not going to update forms. Our assumption before then was that they would update the 2025 forms to give us additional instruction on that. But no, not yet, although I suspect that that's in the conversations with our OAS team. Yes.
That is all that we have for questions right now.
Welcome back, everybody. Thank you for making it through the first session. I think Matt and Sherry did a great job in talking about some of the individual provisions. My name is Ryan Hastings, and Matt's here along with me again, and we're going to talk to some of the business tax updates that were a part of this bill. What we're going to try to do in doing this is understand what those business related tax changes were, compare the old TCJA Act and the new provisions, and you'll kind of see that as I go through the slide deck, and also identify some planning opportunities to potentially optimize some tax outcomes. So just a different way of thinking about some of these things and how they might impact you in the future. So hopefully you'll get some value out of that. The big one that I'm going to start with is the bonus depreciation. Most everybody knows that, you know, before 2022, as impacted under the TCJA, you were able to take 100% bonus depreciation for your qualified property that you placed in service. And as most everybody also probably knows, that in 2023 and 2024, they started phasing that down. And in 2025, the deduction was set to be 40% of the eligible property that you placed in service. The rest of it you would have to depreciate under the regular maker's rules. And again, this bonus depreciation typically applies to personal property with a recovery period of 20 years or less, and certain real estate improvements. So the big change is under the new law, it restores 100% bonus depreciation for any qualified property that's been acquired and placed in service after January 19th, 2025. So I think if you are going to be taking bonus depreciation and you put something in service between January 1st and January 18th, you're going to be limited to 40% on those particular items. But after January 19th, you would be able to expense 100%. And as a component of bonus depreciation, I'm going to talk about this in a minute here. There was a new provision put in Code 168N. And basically, that is going to give businesses the ability to actually expense some manufacturing buildings that they place in service essentially over the next 5 or 6 years here. And you know, that's a very significant provision because, you know, most of the time those facilities are 39-year properties. So the ability to kind of front run that is pretty substantial. And obviously what they're trying to do is encourage the capital investment by, you know, allowing full expensing right now. So we'll talk about this provision a little bit more. Essentially, it provides 100% bonus depreciation deduction for qualified property placed in service before January 1st, 2031. And it defines this qualified production property basically to include any portion of non-residential real property used as an integral part of qualified manufacturing, agriculture, or chemical production, or refining a qualified product that results in a substantial transformation of the product. So basically, most manufacturing is what they're looking for here. Some of the exclusions that are going to be factored in on this is that non-residential real property used for functions unrelated to the actual manufacturing process, such as administrative offices, things of that nature, are going to be excluded. They're also going to exclude if you're in a business that prepares food and beverage in the same facility, essentially, that you manufacture it. I think like tap houses, things like that, they're not going to allow you to do that as well. And then the other category, which I think is going to catch some people, is that it's if the property used by a lessee is not considered to be used by the lessor as part of a qualified production activity. So if the real estate is outside of the business, which a lot of times it is in a separate entity, and there's a lease back and forth, you know, that's not going to qualify, as we know right now. I really suspect that we're going to get some regulations on this, because I think there's going to be a lot of questions and things that need to be clarified on this. But as of right now, you can't, you know, basically as the lessor be able to take the deduction just because your tenant is in the business of manufacturing. Additional requirements, so obviously these rules were to spur economic investment into manufacturing facilities. So such property cannot have been used in qualified production activity by any person at any time, essentially for the past 5 years. So if this was a manufacturing facility, and it's always been a manufacturing facility, you know, you're not going to be, if you purchase it, you're not going to be able to take that immediate expense. And basically the property could not be used by you at any time prior to when you acquired it. So there's going to be two things here. There's going to be people that are going to be constructing these facilities, and there's going to be people that are going to be buying these facilities. So when you're purchasing one, you have to keep in mind, hey, you know, if it was used as an office building in the past and you're converting it to a manufacturing facility, then I think maybe you qualify for this. If you're just buying a manufacturing facility from another party that's used it for manufacturing, I don't think it's going to be eligible. So the other thing to think about here are the rules regards to when this applies. So it applies for property placed in service after July 4th of 2025, but before January 1st of 2031. The construction has to begin after January 19th, 2025 and before January 2029. So that's just a general overview, something maybe to think about in your future plans, expansions, things like that, as to you know, the ability to maybe get a really nice tax deduction there. I'm going to move into 179 expensing. I know most of you are probably familiar with both bonus and 179 expensing because you hear us talking about it all the time. Essentially, under the old law, the TCJA, the taxpayer could expense $1 million every year, and if you put into service more than $2.5 million, it was reduced. Essentially, that $1 million was reduced. The new law essentially adds $1.5 million to the amount that you can expense. So now you can 179 up to $2.5 million, and that's only reduced by the amount when the property exceeds $4 million. Now this is going to be applicable to property placed in service after December 31st, 2024, so it would be applicable for the 2025 tax year. And again, they're trying to encourage immediate capital investment by businesses here in the U.S. Okay, we're coming up to our third polling question here. Starting in 2025, what is the new maximum Section 179 expense deduction limit under OBBBA? All right, looks like most of you got it right at $2.5 million. Okay, so we just talked about the accelerated depreciation, the bonus depreciation, and the 179 depreciation. So I guess what I wanted to talk about is there's differences when you want to use Section 179 depreciation, when you want to use bonus depreciation. Section 179 depreciation cannot create a business loss, so you can't deduct $2.5 million if you have a $500,000 profit. You're limited until you get your taxable income to zero. Bonus depreciation, on the other hand, does allow the business to be driven into a loss situation, which is sometimes beneficial because those losses can then be offset against other business income of the taxpayer coming from other places. So there's times when that's beneficial. The other thing to consider is bonus depreciation is not an all or nothing proposition, but you do have to elect it by class. So I guess what I'm trying to say is we have a bunch of different options available to us when it comes to depreciation. We have, I think of it as like a tool belt. We got all these different options. We have to look at kind of what makes the most sense. And, you know, there's a couple of things that you have to consider as well. I mean, it's not always the best decision to take all the depreciation up front. For example, if you are, expecting your taxable income to be higher into the future, or you're expecting to be in a higher tax bracket in the future for some reason, well, we might not want to take that all on a pass-through entity when you're only getting a 10, 12, 22% tax benefit on it. It might be better to say, you know what, we don't want to take the accelerated depreciation this year. We'd rather take that over time when we think that we're going to be in the 35, 37% bracket. So you have to kind of factor in that. And, also you have to factor in, like, if you put all this stuff in the service and expense it all in the first year, if there's debt associated with that, obviously the debt doesn't go away. So you save money on the taxes, but now you're servicing debt over the foreseeable future with no tax benefit because you used it all in the first year. So there's a lot of things to consider. We think through most of these things or all of these things every year when we're working on your returns, but we can certainly have some conversations in regards to this to make sure that we're doing the best thing for your business. The next thing I'm going to talk about is the 163J business interest deduction. Some of you may know what this is, some of you may not. Typically, if you have average annual gross receipts that are greater than $31 million, you're subject to these 163J rules. And essentially what happens is they limit the amount of interest deduction that you can take on your tax return based upon a formula. And the whole reason for this thing, and it came into play back in 2017, was they were trying to encourage responsible capital structures of the business. This has been quite, if you've run into this in the past, you probably are well aware of it because it's quite punitive. It seems counterintuitive to take away an interest deduction when you're actually using it in the business and it's a business expense. So it kind of went under the radar up until 2022. In 2022, the formula changed on how this thing was calculated. And basically what they did was they said, okay, we used to allow you to add back in your depreciation expense, but we're taking that away in 2023. So basically, when you run through this calculation where you're allowed to take 30% deduction off of your adjusted taxable income, if you're not adding back your depreciation expense and your depreciation expense is high, it's really limiting the amount that you can take as interest expense deduction. Now, you don't lose that. You get to carry it forward until you can meet the rules to use it, but it's pretty painful in the year that it happens. So what they came back with under the new law is they said, hey, we're going to give you back that depreciation add back. So I think if you've been caught up in this in the past, I'm not going to say it's going to make it perfect in the first year or two, but if you typically put a lot of assets into service, I think you're definitely going to have immediate tax benefit based upon them changing this formula. And then they also added, I think, recreational vehicles, campers, trailers to the floor plan financing rules. So anyway, this is going to benefit capital intensive businesses that are and leveraged businesses, those that have significant debt, by allowing you to accelerate those interest expense deductions that you might have had limited in the past.
What I was just you're absolutely right. I think in 2022 we really started seeing, once they went to EBIT and eliminated depreciation and amortization, companies that we wouldn't even really think that we're going to get caught up in it started to, not even that capital intensive, but that their interest started to be limited in certain situations. And yeah, I think this is, start to, a better solution. Ultimately, would love to get rid of 163J, but that's not happening.
Right. All right. Okay, the next provision is the qualified business income deduction. And, we always struggle on where to put this in the presentation. Is it a business thing? Is it an individual thing? It's under the business section here, but I think most people are familiar with the qualified business income deduction. So since 2018 and through 2025, non-corporate taxpayers, S corporations, partnerships, sole proprietorships, single member LLCs have all been able to deduct essentially 20% of their business income coming from that activity, subject to some other limitations. But the gist of it is, if you're profitable, you can deduct 20% of your business profits and take a deduction for it. I feel like over the past 3 years, every time I talk to somebody, I'm like, yeah, I fully expect that they're going to continue to allow this moving forward. I really think that they're going to change it. But beware, because it would have a significant impact if they took it away, And of course they did, keep it. And in fact, they made it permanent. So the whole reason why they did this in the beginning was because of when they changed the corporate tax rates down to 21%, they had to come up with something that, kind of leveled the playing surface with the different entity structures. So long story short is this deduction is continuing on into the future. So I'm sure everybody will be happy to hear that. And it applies for tax years beginning after December 31st, 2025. So it just really extends it out. They did add the other part of this issue is that you have two different types of businesses. You have one that would qualify a non-SSTB business, and you have a service type business. If you're in a service type business, accounting, law, healthcare, you're going to be able to take advantage of this deduction as long as your income levels are below certain amounts. And I think it's $394,600 for a joint return for 2025. If you're below that amount, you get to take this 20% deduction regardless of what kind of business that you're in. If you start getting your income levels above that, it's going to be phased out for those people that are in those special service trade or business, the accountants, the attorneys, the healthcare professionals, and everybody else will continue to be able to take the 20%, assuming they have enough wages that were paid out of the qualified business. So I don't think there's much to say here other than we're happy that this is continuing on and moving forward, and I think everybody will see a significant benefit, continuing on. Poll question number 4, under the OBBBA, the qualified business income deduction for pass-through entities has been great. 80% of you got it right. Made permanent. Thank you. All right. The next thing that I want to touch upon is the limitations on excess business losses of non-corporate taxpayers. So basically, under the old law, under the Tax Cut and Jobs Act, they basically implemented rules where they disallowed losses that exceeded $250,000 for an individual or $500,000 on a joint return for business losses coming through to that return. As you would aggregate all the businesses that you had, and if it was in excess of the $250,000 or $500,000, they would not allow you to take that deduction in that year, even though you had the loss in that year. And what they would do is then that would roll over and essentially becomes part of a net operating loss that you're able to take in future years. So it's almost like a one-year deferral type thing of that on that particular year. What they did under the new rules is that they're keeping this in place, but they're indexing it for inflation. So it's been 250, 500 for several years now, and those amounts will obviously go up with inflation, which is nice, and it does retain the treatment as an NOL carryover. So if you are limited, it does make it a little bit easier for you to take in future years. So that's the update on that. I think I'm going to turn it over to Matt now to finish up the business section here.
So next up, we want to talk about small business stock gain exclusion. So this is section 1202 under TCJA. Essentially, we're looking at when you have gain on the sale of qualified small business stock that's held for more than 5 years. There was different different exclusions based upon when the small business stock was acquired. So under the old rules, if it was acquired after September 27, 2010, the exclusion was 100%. Anything acquired before 2010, the exclusion was between 50 and 75%, and the limitation or exclusion was $10 million. What OBBBA did was put in some additional exclusions tiers, and this is for, you need to make note that it's for qualified small business stock that's issued or acquired after July 4th, 2025. So anything that was acquired before that period still is under the old rules, but the new criteria then for the stock after that time period, basically what they did, instead of having to hold it for 5 years, it tiered it into, if you held it 3 or more, basically 3 years, 50% of capital gains can be excluded. 4 years, 75% of the gains excluded. And if you held it 5 or more, 100% of those gains can be excluded. What they also changed is they increased the exclusion cap from 10 to 15 million. They also, for testing of whether the corporation qualifies as a small business, they increased the maximum gross assets from 50 million to 75 million. And this is indexed for inflation starting in 2026 as well. So always one of the things we want to look at when you have small business stock that might qualify, definitely a big savings there in that regard. So just a more complexity to it, different rules need to keep in mind. As far as clean energy incentives, we have a chart kind of added here. There's a lot of clean energy incentives that are being phased out or eliminated. And like I said before, there's just a lot of different dates. So have here the different code section, the name of the credit or deduction, and the termination date. The ones that I think we see kind of the most are the clean vehicle credit, home efficient home improvement credit, energy efficient commercial buildings deduction, 179D. Those types of credits, probably what we see more often, but there are other ones here. Don't want to go into too much detail. You don't see a whole lot, but could be applicable in certain situations. So just again, wanted to point out these credits that are being phased out are eliminated and what date. One of the other changes is for the employer provided child care credit for businesses under TCJA. This was a credit for employers that provided child care. Credit was 25% of qualified child care facility costs with a maximum annual credit of $150,000. OBBBA has retained this, but increased that credit, maximum credit and percentage and dollar amount. So instead of 25%, it's been bumped up to 40% with a maximum annual credit of $500,000. Plus, they've added for eligible small businesses now too, another layer that could be 50% of the costs or $600,000 as the maximum credit. Another credit for businesses is paid family and medical leave. Under TCJA, this credit was added and was between 12.5% and 25% of wages paid to employees on family and medical leave, and this was through 2025. So OBBBA has made this credit permanent, and the other provision that they kind of added to expand it a little bit was to give an option to calculate it two different ways. So the previous way, but also using a percentage of premiums paid instead of those wages. So polling question number 5, what business tax provision is most relevant to you? And it looks like 37% said QBI made permanent, and then 35% coming in at the restored bonus depreciation. Other at 24%. So be interested if anybody wants to send through the chat, I mean, what other items you're looking at as well that is of most relevant to you. But yeah, I think those are, the 2 items that we would expect as well. A couple other provisions from a business standpoint that we just wanted to point out. From a C corporation standpoint, they've added an additional charitable contribution limitation. So just like when we talked about from the individual, kind of this floor getting put in for charitable contributions, they're also for starting in 2026 for C Corps, there is a 1% of taxable income floor for charitable contributions. They still have the 10% of taxable income maximum amount. So they just kind of added that to, which reduces the benefit, some benefits there for C corporations for charitable contributions. 1099-K reporting. I know this has been over the last couple of years a very interesting subject, and the thresholds on third-party processor payment processors that limitation had really dropped, and you start seeing a lot more 1099-Ks being issued. What OBBBA did was reverted back to the 20,000 and 200 transaction threshold. So I think, that's definitely a lot less that we're going to be seeing. And think about PayPal, Venmo, those kind of payment processors that had to send those out. And so, again, a big change there for the good. Form 1099 miscellaneous and NEC reporting, starting for payments made after December 31st, 2025. The threshold is going to increase. It had been $600 for probably forever.
Right.
And they've increased that to $2,000. So I think that's going to be something that's going to be hard for people to remember and keep in mind when they're thinking about 1099, since it's just been there forever. But hopefully it will help a little bit of reduce some 1099s that need to be issued by businesses. And again, that's after this year. So still have the 600 threshold for payments made in 2025. Lastly, employee retention credit. I think everybody always thinks, well, that's gone away. It's been over with, but it's still very in everybody's minds because of fraudulent claims. So what OBBBA did was two things, a bunch of things. One was included some enforcement provisions to target fraudulent ERC claims was one of the items. The other relevant piece that OBBBA did was it retroactively invalidated claims that were filed after January 31st, 2024 for the third and fourth quarters of 2021 ERC. So any businesses that may be in that situation and still waiting for refunds, if those amended 9041s were filed in order to claim the ERC after that January 31st, 24 period, you're not going to get it for third and fourth quarters of 21. This has made it has invalidated, so you're not shouldn't be expecting to receive those. If you file before that period, it just might be a waiting game at this point, just for the IRS to catch up and issue the refunds. So lastly, we just kind of wanted to recap from a business standpoint. I mean, this is some high level summary of the business provisions, what to expect. I mean, going forward, definitely, like I said before, more guidance is needed from IRS, Treasury, just how to implement some of these provisions. And again, like Sherry had said earlier in the individual section, we're getting some guidance. Just recently, August 7th, the IRS had announced that the forms W-2, 1099, 941, and the other payroll returns will remain unchanged for 2025 tax year. So, the things that, we were hoping or expecting maybe they would be changed, so we had information on the actual form for some of these provisions, won't be there. So it's a matter of gathering the information in another way. And then the IRS also announced at the same time that the federal income tax withholding rates will not be updated for these OBBBA provisions for the 25 tax year. And also that employers and payroll providers are to continue using current procedures for reporting and withholding. Basically, at the end of the day, what I think the IRS was trying to come out with here was to not stall the 2025 tax filing season and make have to update all systems from these forms. They have to make changes for 1040s, 1120s, all the other income tax forms. But for these forms that all employers were going to be affected by it, they didn't want to make those changes and have to, start retroactively kind of gathering this information for the actual form. So they just didn't want to kind of stall that piece of it. And lastly, Ryan had talked about it a little bit, depreciation, state impact, but all of these provisions, whether it's individual or it's business, always the next step after an act has passed from a federal standpoint is how will the states adapt to it? What are the states going to do? Are they going to follow it? Or are they going to do something different? And every single state could be different on how their tax rules are set up in the first place. And, do they automatically adopt the federal rules and then have to say that certain rules they're going to decouple from? Or are they, a state like Pennsylvania that for for personal income tax purposes that they don't follow automatically the federal rules and they adopt the ones that they would want to. So a lot more guidance that we need from states. It always takes a lot of time from a state perspective to kind of catch up, pass laws, rules in the states. And every state's going to be on a different time frame. So more information to come on that. So we will take questions for business tax updates as well.
What is the revenue level for applicability of Section 163J interest deduction?
So it's $31 million of your average annual gross receipts, and you have to calculate your average annual gross receipts, you go back to your three prior tax years and average your gross receipts. So if they're under 31 million, you're okay, you don't have to worry about it. If it's over 31 million, then it would apply to the business. The other thing to mention there too is that there are some aggregation rules in regards to this. So if you have multiple businesses and essentially most of the ownership in those businesses, I think it's Code Section 448, you have to aggregate them and evaluate them together when you're looking at that $31 million threshold. So the rules are a little complicated, but $31 million is the target.
And that's constantly changing because it's part of inflation related. So it's a number that's always moving and always changing as well.
Has there been any news of whether the forms will change after the 2025 tax year?
They have not said, but I would expect that they would be changing because it just, one of the things that was in the tips, deduction for tips was about occupation. And so that you know that they're in a qualified occupation to be qualified for the tip deduction. So I think there's a lot of things that, and the overtime, there's a lot of things that would be very useful to be on the W-2 or 1099. So I think that there will be changes coming up, but there has been no mention at this point of what those changes would be and when they would occur.
Who will be responsible for calculating overtime?
I think it'll be the employer, right? I mean, the employer is going to follow the regular payroll overtime rules, and they should have that information available to them. That, as I understand, they're going to have to file a report.
The law requires them, the employer, to provide that to the employee. So it'll be the employer's responsibility.
Yeah. So employer's responsibility. Yeah.
That is all for questions right now.
Thank you.
So next up, we have Pat will be joining to talk about R&D tax credit and 174 updates.
All right, thank you, Matt. I'm unmuted, right? Okay. Yeah, it's R&D tax credit updates. It's important that we follow both federal for the businesses as well as the individuals. So it's probably perfect timing in the presentation. The R&D follows both because it has a direct impact to both of them. Common theme, obviously, OBBBA. The number one item that we're talking about today when we're talking about the R&D update, is the Internal Revenue Code section 174 that, if we look backwards, TCJA required many businesses effective 2022 onwards, that includes 2024, to capitalize these costs. So the update we're sharing with you today is OBBBA has provided guidance and law that effectively domestic R&D, not all, but only the domestic R&D is fully restored for deductibility. So the agenda will capture a few things. Number one, how to recover those mandatory capitalized costs due to Tax Cut and Jobs Act from 22 to 24, conforming changes when it requires for when you're filing your R&D credit, which is section 41, and then 280C, which is the reduced credit election on 67, 65. Accounting method changes or updates per se, next steps, taxpayer considerations, and then please use the Q&A, the chat box throughout. I know we're going to be probably pressed on time, so make sure you get them in so we can obviously address those. So obviously, July 4th issued the Tax Cut and Jobs Act 174 requirement is gone. So it reverses it. We're now able to deduct. What does that mean? So today, the common theme is, again, even the presentation title is what it means right now. So today being August 14th, we have 30 days essentially before a lot of these either small businesses or regular businesses, whether pass through or if it's a C Corp, obviously we have 60 days. But ultimately, something has to come down the pipe to understand what we're doing. Okay, it says you're muted. Okay.
No, you're not.
Good. All right, so what we need to understand is immediate deductibility of expenses. This allows us options for either future, and this is probably piggyback off of what Matt and Ryan just talked about, is the average gross receipts of 31 million. So that in small businesses, you actually have an option to retroactively go back and accomplish and deduct these costs. Also the amendments, as we mentioned, section 41 and 280C. So effectively January 1st, 2025, businesses no longer required to capitalize or amortize these R&D activity expenses. So as I mentioned, it applies only to US costs. The foreign aspect still has the 15-year amortization requirement. And then therefore, if you are in a position where you don't want to deduct your costs immediately, you do have the optional 5-year amortization requirement, or sorry, availability that used to be the requirement. You are allowed to keep that accounting method in play per se. So the unamortized costs, so the flexibility, so if you're above the $31 million gross receipt average, you have basically two options. First one is claim the unamortized 174 cost, all the costs that you capitalized in 2025 alone, or you can do it in an even spread of both 2025 and 2026. So if you're, as I mentioned, above the 31 million gross receipt piece, you have basically two options. You have to go forward, you can't go back. These small businesses, however, have relief where you're able to amend your tax returns, or again, waiting on guidance, there might be some catch up that we can look into that could impact today to let us know some guidance per se. But you could go back in 2022, 2023, and I know some people haven't filed 24 yet, but if you did file 24 as well, you can do a full immediate deduction of those R&D costs, basically recovering any deferred expenses. You don't have to. There's not a requirement. So if you are a small business per se, you don't have to look back and say, well, is that my only option? Do I have to go to 22 only, 23 and 24? You could use the same methodology and take all in 25, or do 25 and 26 in an even split. So this provides, flexibility to either have your R&D credits, the ones rolling forward, or if your estimated tax payments in play, you can understand what your tax liability looks like for the future for 25 planning, as well as 26, and understand that, you know, there is flexibility amongst these. So I'll pause there. There is a polling question, which is our 7th, 6th. Okay, so in the polling question, I do like that a lot of folks elected not to amend, and obviously review with your CPA to determine, as most people say, tax law is out there, let's get the money, let's go back and make it happen, you know, amend. Obviously wait, you know, we need guidance. You know, I have in front of me today too is AICPA wrote a letter regarding 174 to the AICPA to basically understand we need something in the interim now that helps specifically clients or taxpayers, I should say, that haven't filed their 24 tax return yet. So again, right now, a lot of our individuals are waiting on guidance as we are, but there has been a letter passed along to the Treasury to understand, you know, we want the immediate expensing. The current law as it reads requires that, or I should say suggests that a 24 return has to have the Section 174 capitalization requirement, and then in turn must be amended. So right now, that just doesn't make the most sense for processing a return from the IRS standpoint. And really for the taxpayer, you're going to pay your money in for tax purposes and that have to turn around and get them right back. So we want to understand, and obviously this letter states that there has to be a method claim with it. There has to be a statement. So the more we find out there, we'll pass that along as soon as we find that out as well. But keep in mind what we're talking about today, Section 174, you know, all of your R&D credit costs, which is, you know, we'll share them on the next slide, you know, they must really equate to 174. So if you have R&D, and if you're taking the credit, you have 174. But in the inverse, not all Section 174 expenses, even if you don't have R&D costs, or if you don't have R&D tax credit claims, you possibly could have 174. So folks that have capitalized or have not capitalized, you do run the issue. You have to look at your costs issue and understand what it is you have to do. So for Section 174, it's a little bit more expansive. It's not just the traditional cost, it's overhead, it's employee burden, which is full instead of box 1 for your R&D tax credit purposes. It's box 5, which is employee burden, taxes, benefits, insurance. A lot of those costs qualify for the R&D, but again, a little bit more expansive for 174. So your expenditures for the credit are going to be a little bit lighter than your Section 174 expenses. So what are the costs that we're talking about ideally just for the R&D tax credit? That's the wages, the supplies, computer leasing, and contractor research. So these activities used in the R&D essentially yield the credit, and that's what we're talking about for what can be deducted or what can be capitalized if you opt to use that method. No changes to really how the credit's computed or how it's deemed qualifying. There's still that 4-part test. So the IRS has not changed anything other than the deductibility. So the credit does remain, you know, 4-part test, permitted purpose, technological nature, the uncertainty piece, the process experimentation. Make that a little cleaner on the next slide here. Gives you the actual tax code. So Section 41, as you see under each of those or next to each of those number signs there, that's Section 41, which is the credit. What we're talking about too is Section 174, which you think about, I mean, that's the more expansive. You think about a little bit of a pyramid. So the credit's the top. So you have your costs for the R&D are a little bit more minute detail. Section 174 is a little bit more expansive, as we talked about. It's additional costs. It's really the full burden. So it's not just box 1 W2, but it's the box 5, which is fully burdened wages. So the costs associated and capitalized over those years from 22, 23, 24 could provide a pretty substantial number when it comes to if you opt to go, take all those deductions in 1 year. We looked at some of the numbers for some of our current clients. It's roughly 2 million, 3 million, that adds up quickly. So obviously work with us to determine, what you want to do. Polling question number 7 correlates right back to the 4-part test. One person. There's always that one, the 1%. Good job. Yeah, 4-part test. As I mentioned, the R&D claim, it's the standard of approval. That's how we have to determine what qualifies. So sticking on that note, when you do have an R&D credit claim, which is your section 41, there is now a requirement that in the past, when you did have the capitalization piece from 22, 23, 24, you're obligated, so your OBBBA has modified that you are obligated to reduce your R&D expenses by the amount of the gross credit. So 280C election, and if you have seen the tax form, it's a checkbox. It's an election that can be claimed only on timely filed tax returns, including extensions, that basically is consistent from the pre-Tax Cut and Jobs Act rules. So 280C is the preferred method, the preferred election. So you're not going to have the gross credit claimed on your tax return. You essentially are now required to reduce. So last week on this slide, 41D was amended now to require expenditures to be treated as domestic R&D under 174 eligible for the credit. So the section 174A is the new piece that essentially OBBBA rolled into fruition for right now. So accounting method changes is key. So as we talked about all throughout the theme of this presentation, we need guidance. So accounting method changes, typically we look for automatic changes. So the IRS is going to have to issue a new list or a new number. So if you do file your 2024 return and you're going to be claiming, you do need to find and have an election that is rolled out by the government at the moment. So in our current review of the law, applying section 174A treated as a taxpayer initiated method change, implemented at a cutoff for base years for December 31, 2024. So keep in mind too, there could be folks with their fiscal year ending in 25, which makes this even more of a dire situation. So with section 41A, the required adjustment, as I mentioned, short year returns, we want to check that, but our review of the current law has no 41A adjustment required. So as I mentioned, this kind of really realigns to what the law was or what the requirement was with claiming the R&D as well as claiming your deductibility of expenses for the pre-Tax Cut and Jobs Act. So summary and next steps, immediate expensing obviously for the R&D. Foreign is still amortized over 15-year. Retroactive relief for small businesses, which is again the $31 million gross receipts. You can amend your tax returns for 25, 24 to 25 through 24 to claim those full immediate deductions for domestic and potentially recovered previously deferred expenses, meaning those capitalized costs, which again could add up relatively quickly. Review accounting methods. We want to ensure that again, with the 24 returns due in the next 30 or 60 days, we want to make sure we have the elections. So we'll continue to monitor and understand what guidance or what elections come down from the IRS side. So at the moment, last question here for polling. All right, mixed reviews here. So again, work with either your CPA, work with the R&D experts, work with anybody that can help understand, what it is we need to do to either, A, if it's a 2024 return, you want to be able to deduct the R&D expenses now, but you can't do it without having the guidance first. So we need to have, whether it's a valid election, a valid statement, whatever we find out from the letter, I guess the response letter from the Treasury, that will issue guidance, most likely will issue a Rev Proc that will have, whether it's an automatic change, what's the code. But really, again, the law suggests that for 24's return, Section 174 costs have to be amortized. So really, in retrospect, hold off and wait unless you're going to file your return, capitalize it, claim the R&D credit, and then want to be able to deduct it, you might have to turn around and amend your return. So if you have the option, please hold off and wait until we have further guidance to understand. Lastly, the letter also mentioned that if it's an NOL year affected within 22, 23, 24, specifically 24, is to allow adjustments in the carry forward years instead of going into those NOLs in those amendment years. Again, if we can hold off and wait, if the NOLs are adjusted, you're able to do it as a going forward basis versus going back and amending those specific years. Quick next steps, this is kind of more of a public service announcement as we're working through it. With 2025 tax year effectively coming soon, the Section 174 goes away, which is great. It still means there's still a lot of work that comes with the R&D credit claims. So the forms have changed. There's elections and sections in there that were optional in 2024 that will be mandatory in 25. So there's more documentation needed, more complexity. If you listen to us in the past from the May webinar, basically it's coming down to what they want to consider a business component. So you almost want to have project accounting dictated on your form now. So you want to be able to correlate what costs were associated to which business component, which is essentially a glorified term for what are your new products, processes, or improvements to the existing. So the wage classification is important too. So it's looking at who's involved directly, but as well as it wants to bifurcate out and understand who's overseeing those, what's the chain of command and how much of their time correlates. So it kind of looks at it and says, well, you almost are giving the government an R&D tax credit study on your actual form requirement now, claiming on the tax returns. So Section G is really where this is all going to come as added. So we can share that in our added resources or our coming soon information. But for now, I will take questions, comments, concerns as we're working through it. We're pretty good on time.
Will you be able to deduct patent costs that were not amortized in prior years?
You would have to, so if you're rolling them all up, if you didn't deduct them, you capitalize them essentially, I would hold off on that because that still would count as a 174 piece. So that one doesn't qualify for the credit. So Section 174A, patent costs would be excluded, so you wouldn't have the deduction other than we'd have to look and see if there's further guidance on it.
For small businesses, if you've not filed for 2024 yet, can you just deduct 2024 expenses?
Hold off on that. That's been the theme where we need guidance. So as the law, as it refers to right now, is you're not able to just deduct those R&D expenses. It's still looking at it as capitalization requirement with the retroactively going back and seeking relief. So don't just file your return just yet without proper election, without proper method until it's rolled out.
Do you see any movement on the IRS finalizing proposed regulations under 174 in light of the recently enacted law?
They do. They have to come out with essentially a Rev Proc, more guidance, like they specifically do, and sometimes it comes in an inopportune time. I remember they issued something in September of, I think, 23 when it came down to software development and how it correlated to 174. But yes, I do see there further guidance and further understanding from the IRS side. There has to be at this point.
Do we do R&D study consulting for clients to see if they could get the credit and if amending the returns are feasible?
Yes, please reach out. We look into, again, if you never claim the credit, we look into see if there is opportunity of dollars on the table missed, or if you are claiming essentially the credit and you have those capitalization costs in those years. We look at both to ensure what is the proper steps going forward. Do you go into 25 only and deduct, do a 25 and 26, or does it make sense to amend? Again, we want to make sure we are optimizing the credit as well as maximizing your dollars in your pocket when it comes to the credit and deductions.
Right.
Okay. Other helpful resources, obviously we mentioned the AICPA letter. So tax provisions, effective dates, I know that's part of it, but if anybody wants a copy of the letter as well, we can update that and add it. But please follow us because we are seeking all the answers to what the latest and greatest from the IRS side, as well as AICPA's guidance. Appreciate your time today. And if there's anything else, any last questions in the text box, please ask them now. But again, appreciate your time.